What's up to all my hustle buddies out there in the gig economy? Doordash, Instacart, Grubhub, Postmates, what have you, Lyft, Uber, whatever. You got about 4 more weeks until the tax filing deadline, and you might not know where to start. But I got you covered on this episode of Office Hours, so let's go. What's going on? This is Dominique Henderson, your friendly YouTube CFP, coming at you today on Office Hours with something for all my side hustlers or hustlers out there in the gig economy. No matter what you do to bring in that extra income, the point is you worked real hard for it and you don't want to pay more than your fair share, but you might not know where to start, right? You got all kinds of receipts everywhere and expenses and 1099s and the whole jazz. And I want to give you a real cool method to kind of organize all this jazz so that you can make the filing deadline in the next 4 weeks. And if you don't, you can just always extend. I think the first thing you need to be doing is you have to have a system for organizing this. So I got another podcast on this that I'll link up in the cards, but let's go through some of the granular stuff because the IRS is looking for certain things. And I want you to avoid the trap of getting audited and getting caught with your knickers down. So what do you need to do? Well, as a gigger, when you work for, let's just say Lyft is going to send you something because you're an independent contractor, you're not an employee. So as a self-employed person, they're going to send you a Form 1099. It looks like this. That Form 1099 has to be filed with the number of the amount of money that you've earned that particular year from Lyft. If you don't do that, that's a problem. Here's why. The IRS will get a copy of that form from Lyft. They have to file that whenever somebody makes over X amount of dollars. I don't know what the amount is right now in the economy from a particular provider like a Lyft or a Doordash or a Postmates. They have to send that out. So the IRS is getting a copy of that and you might as well file that. Where does that fall though? That is revenue to you. So if you're kind of thinking through a business, let's give you business 101 or profit and loss statements 101. You got revenue, you got expenses, and then from that, you're gonna have net income or profit. So this is gonna fall into that revenue department, which leads to my next point. What are you using to record these income sources or revenue and expenses for that matter? Hopefully you don't have a shoebox full of receipts. A shoebox full of receipts is what people used to do back in the 19th and the 20th century. We're in the 21st century now, so you need to be using an app or some type of desktop, maybe QuickBooks Online. I use Wave apps. I love it. It's free. It gives me professional looking business statements, profit and loss, general ledger, balance sheet, the whole nine. Just you hook up your bank account with a really cool integration and it sucks all the transactions in. And I spend, maybe an hour a month categorizing all those and making sure that I'm reconciled. You can do the same thing. Or you can hire somebody to do it if you don't like bookkeeping. With me being a YouTube CFP, I do my own books. So you got your revenue. And hopefully you're recording your expenses in something other than a shoebox. The thing that you need to be really attentive to is that all of this is going on Schedule C of an IRS return. Up there again. So after you get to all your revenue, subtract all your expenses, this is anything that you've used in order to make income. The IRS defines this really broadly, meaning that if you are in pursuit of income, pursuit of revenue, pursuit of a business to make revenue, you are in the business to make a profit. Anything that you use, any expense that you incur in order to do that can be deducted. So you just want to record that. Now, you've got all your revenue, you've got all your expenses, and you got a net profit or net income. You are subject to taxes on that number. It's called self-employment taxes. So what can you do in order to reduce this number? Well, I'm gonna give you a list of expenses that are probable, that are, let's say normal in the course of conducting a business. But I'm gonna give you a bonus tip also. This list right here is not an all-inclusive list. You also want to think about the following. If you have net income and you're not operating at a loss, so your business actually made money, what you can do is you can take the lesser of 25% of that number, or up to $55,000 for calendar year 2018, for the tax year 2018, and you can deduct that from your liability even further. What do you do with that money? Well, you put it into a retirement account, a simplified employee pension account. SEP IRA for short. So this SEP IRA works just like any other IRA where you can put the money in there, invest into the market, get a return, not pay any taxes until age 70 and a half. That money is deferred until that long. It's tax deferred until that long, and that's what you want to do. These are some of the tricks of the pros, so they don't pay more than their fair share. You've got to find all the deductions that are out there so you reduce your tax liability as far down as possible, as legally possible. All right. Are you confused? Do you still not know what to do? Or is it just the fact that you just don't want to do it yourself? Which I understand. I totally understand. Do me a favor. Dial the number below, 214-699-7599, extension 1. Ask for me, and I'm going to hook you up with my tax package. We do wealth management, and we do tax oversight in-house. I would love to help you out, see what your situation is, see if you need some extra help, see if you need some perspective. You can always leave me a comment below. I will answer the question. I read all my comments. Would love to have you on the channel in this community, so please subscribe if you get a chance, especially if you like what you're hearing. We'll talk to you later. Bye-bye for now.